Stop what you are doing. This is not a scheduled broadcast. This is an emergency alert. Something happened in the silver market over the last 18 hours that has never happened before in the history of commodities trading. Something so brazen, so massive, so blatantly manipulative that it defies comprehension. We have been tracking silver manipulation for years. We have documented the paper games, the concentrated short positions, the coordinated attacks on key technical levels. We thought we had seen it all. We thought we understood the depths to which the bullion banks would sink to maintain their control over the silver price. We were wrong. What happened today makes every previous manipulation look like a children's game. The numbers that crossed our screens this morning represent an operation so large that it required the coordination of every major financial institution on the planet. 1.8 billion ounces. Let that number sink into your consciousness. 1.8 billion ounces of paper silver traded in a single session. That is more than 2 years of global mining production. That is more silver than exists in deliverable form in every vault on Earth combined. That is a number so impossibly large that it could only exist in the fantasy world of paper derivatives where silver is created and destroyed with keystrokes rather than mining and refining. Ladies and gentlemen, this is Silver Storm Daily, and tonight I am going to expose the greatest pump and dump operation in the history of precious metals. I am going to show you exactly how they did it, who was responsible, and why this desperate gambit is the clearest signal yet that the silver market is about to break wide open. Let me walk you through the timeline of what happened because the sequence of events reveals the calculated nature of this operation. At 11:47 p.m. Eastern Time last night, just as the Asian markets were entering their most active trading period, the first phase began. A massive wave of buying hit the COMEX Globex electronic trading platform. 15,000 contracts in the first minute. 75 million ounces of paper silver purchased instantaneously. The price spiked from $94 to $99 in 60 seconds. The algorithms detected the momentum and piled in. Retail traders who had been watching the charts saw the breakout and started buying. The momentum became self-reinforcing. By midnight, silver had touched $103. By 1 a.m., it had reached $107. The euphoria was palpable. Social media exploded with celebration. The breakout that everyone had been waiting for appeared to be happening. But something was wrong. The buying was too aggressive, too concentrated, too perfectly timed. Experienced traders began noticing anomalies in the order flow. The bids were coming in blocks that were too uniform. The timing between orders was too regular. This was not organic buying driven by fundamental demand. This was algorithmic buying designed to pump the price as high as possible in the shortest possible time. The entities behind this buying did not want silver at $107. They wanted silver to appear to break out so that they could dump their positions on the momentum chasers who would inevitably follow. The second phase began at 2:23 a.m. With silver trading at $109 and the market in full FOMO mode, the selling started. But this was not gradual profit-taking. This was carpet bombing. 22,000 contracts dumped in the first 3 minutes. 110 million ounces of paper silver thrown onto the market like garbage. The price dropped $8 in 3 minutes. The algorithms that had been buying reversed course and started selling. The stop losses that traders had placed below key levels started triggering. The cascade began. Over the next 4 hours, wave after wave of selling hit the market. Each wave was precisely timed to hit when the price seemed to be stabilizing. Each wave was precisely sized to break through the next support level. At 3:15 a.m., 10,000 contracts pushed silver through 100. At 4:42 a.m., 12,000 contracts pushed it through 95. At 5:17 a.m., 8,000 contracts pushed it through 90. At 6:31 a.m., the final wave of 15,000 contracts pushed silver to its ultimate low of $83.47, from the high of $109 to the low of $83, a $26 move, a 24% round trip, executed in less than 8 hours. Now let me give you the total volume numbers because this is where the true scale of the operation becomes apparent. According to the CME Group's preliminary data, total volume on COMEX silver futures during the 18-hour period from 6 p.m. Eastern yesterday to noon. Eastern today was 362,000 contracts. Each contract represents 5,000 ounces. 362,000 contracts times 5,000 ounces equals 1,810,000,000 ounces of silver traded. 1.8 billion ounces in a single trading session. To understand how absurd this number is, you need to understand the actual silver market. Total global silver production is approximately 800 million ounces per year. Total above-ground silver stockpiles are estimated at 2 billion ounces. The COMEX registered inventory is under 10 million ounces. The entire London Bullion Market Association holds perhaps 1 billion ounces in its vaults, though the exact number is opaque. In this single session, the paper-silver market traded more ounces than the entire annual global production. It traded nearly as much as all the silver that physically exists on the surface of the Earth. This is not a market. This is a casino where the chips have no relationship to reality. The pump and dump pattern is unmistakable when you look at the volume distribution. Approximately 800 million ounces were traded during the pump phase, driving the price from 94 to 109. Approximately 1 billion ounces were traded during the dump phase, driving the price from 109 to 83. The entities that executed this operation bought silver to pump it up, then sold even more to crash it down. They used the momentum they created to attract buyers, then crushed those buyers with overwhelming selling pressure. They profited on both sides of the trade while retail investors were left holding the bag. Let me explain the mechanics of how this pump and dump works, because understanding the mechanism is essential for protecting yourself. The perpetrators start with a plan. They know that the silver market is thinly traded during certain hours. They know that algorithmic traders will follow momentum. They know that retail investors watch key technical levels and will buy breakouts. They know that the media will report on dramatic price moves, attracting more attention and more buying. They exploit all of this knowledge to execute their scheme. Phase 1 is accumulation. Before the pump begins, the perpetrators quietly accumulate a position. They buy slowly over days or weeks, careful not to move the price. They use multiple accounts and multiple brokers to disguise their activity. They build a war chest that they will deploy when the time is right. Phase 2 is the pump. At a carefully chosen moment, usually during low liquidity hours, when a small amount of buying can move the price significantly, they unleash their buying. They buy aggressively and visibly, creating the impression of a breakout. The price spikes. The algorithms follow. The retail traders FOMO in. The momentum becomes self-sustaining. The perpetrators continue buying to keep the pump going, attracting more and more buyers. Phase 3 is distribution. As the price rises, the perpetrators begin selling their accumulated position. They sell into the strength they have created. They are not selling to take profits on a legitimate trade. They are selling to transfer their bags to the unsuspecting buyers who think they are riding a genuine breakout. The distribution is gradual at first, hidden within the noise of the trading. But as the price approaches their target, the selling accelerates. Phase 4 is the dump. Once the perpetrators have distributed their long position, they flip short. They begin selling aggressively, not to exit a position, but to crash the price. The same traders who bought the breakout are now facing losses. Their stop losses trigger. Their margin calls hit. They are forced to sell, adding to the downward pressure. The perpetrators continue selling, driving the price lower and lower, covering their shorts at the bottom. Phase 5 is the reload. At the bottom, the perpetrators cover their shorts by buying. They are now ready to repeat the cycle. They have extracted wealth from retail traders on both the way up and the way down. They have created volatility that will attract more traders to exploit in the future. They have demonstrated their power over the market. This pattern repeated multiple times within the 18-hour period we are analyzing. There were at least 3 distinct pump and dump cycles nested within the larger operation. Each cycle transferred wealth from retail traders to the perpetrators. Each cycle increased the total volume, ultimately reaching the staggering 1.8 billion ounce figure. Now let me address who is responsible, because the CFTC data and the pattern of trading point to a very specific set of actors. The volume traded during this operation was too large for any normal market participant. Hedge funds do not have the credit lines to trade 1.8 billion ounces of silver. Retail traders collectively do not have the capital. Mining companies and industrial users do not trade in these quantities. The only entities with the capacity to execute a 1.8 billion ounce operation are the bullion banks. The commitment of traders report that will be released Friday will show the positions, but we do not need to wait. The bank participation report and the concentration data already tell the story. 4 commercial traders, all of them banks, hold over 70% of the commercial net short position in silver. These same 4 banks were responsible for the overwhelming majority of today's volume. They have the trading infrastructure, they have the credit lines, they have the relationships with the clearinghouses, they have the regulatory capture that allows them to operate with impunity. The specific identities are not officially disclosed, but cross-referencing the available data with information from market sources points to the usual suspects. JP Morgan, which has been the dominant force in silver trading for decades. HSBC, which operates one of the largest precious metals trading desks in London. Bank of America, which has expanded its commodities trading aggressively in recent years, and Citigroup, which has deep connections to the COMEX and the CME Group. These four banks have the motive, the means, and the opportunity. They are the perpetrators. The motive is clear. The banks hold massive short positions in silver. They have been short for years, rolling their positions forward, hoping that the price would eventually fall and allow them to cover at a profit. But the price has not fallen. It has risen relentlessly from $25 to over $90. The banks are underwater by tens of billions of dollars. Every dollar that silver rises adds to their losses. Every rally threatens to trigger margin calls that they cannot meet. Every breakout brings them closer to extinction. They are fighting for survival. And today's pump and dump was their latest weapon. The means are equally clear. The banks have unlimited credit when it comes to trading commodities on the exchanges they help control. They are the market makers. They are the clearing members. They set the rules and enforce the rules. They can trade quantities that would be impossible for any other participant. They can coordinate their activities through shared trading platforms and communication channels. They can execute operations like today's pump and dump with precision that would be impossible for uncoordinated actors. The opportunity arises from the structure of the market itself. The COMEX is a paper market. The contracts traded on the COMEX are not backed by physical silver in any meaningful ratio. For every ounce of registered silver in the vaults, there are dozens or hundreds of paper claims. This paper leverage allows the banks to create and destroy silver with keystrokes. They do not need to actually own 1.8 billion ounces to trade 1.8 billion ounces. They only need to create paper contracts that reference silver without actually being backed by it. The paper market is the weapon. The physical shortage is the weakness they are trying to hide. Now let me explain why this pump and dump, despite its apparent success, is actually a sign of desperation and a guarantee of the bank's ultimate defeat. The very size of the operation reveals how precarious their position has become. A year ago, the banks could move the silver price with a few thousand contracts. Today, they needed to trade 1.8 billion ounces to achieve a $26 move. The diminishing returns are obvious. Each manipulation requires more firepower than the last. Each operation exposes them to more regulatory scrutiny. Each failure to permanently suppress the price demonstrates that the physical market is overwhelming the paper market. Consider what the pump and dump accomplished. Before the operation, silver was trading at $94. After the operation, silver is trading at $88, a $6 decline. They traded 1.8 billion ounces, more than 2 years of global production, to achieve a 6% decline. And even that decline is already being erased. As I record this video, silver has bounced from the $83 low to $88. The physical buyers are absorbing the paper selling. The dip is being bought. The pump and dump also damaged the credibility of the paper market. Traders who were whipsawed by this operation will think twice before trading COMEX silver again. They will recognize that the market is rigged. They will move to the physical market where manipulation is impossible. Every retail trader who loses money to a pump and dump becomes an enemy of the paper system. They tell their friends, they post on social media, they create the narrative that ultimately destroys the manipulator's franchise. The pump and dump wasted ammunition that the banks cannot easily replace. Each paper contract they sell requires margin. Each position they hold requires capital. The capital is finite. The credit lines have limits. The banks are drawing down their reserves with each manipulation. Eventually, they will run out. Eventually, the physical demand will overwhelm their paper supply. Eventually, the game will end. Let me now address what is happening in the physical market, because the disconnect from the paper market has never been greater. While the paper price crashed from 109 to 83, what happened to physical silver premiums? They went up, not down, up. I surveyed 12 major dealers during and after the crash. Before the pump began, Silver Eagles were selling for $114, a $20 premium over the $94 spot. After the crash bottomed at 83, Silver Eagles were selling for $112, a $29 premium over spot. The dealers did not lower their prices in response to the paper crash. They raised their premiums because they recognized that the crash was fake. This premium expansion is the physical market's verdict on the paper manipulation. The dealers who buy and sell actual metal know that the paper price is fiction. They know that they cannot source silver at $83. They know that their wholesale costs did not drop during the crash. So they maintained their prices and let the premium expand to absorb the paper volatility. The customer who walks into a coin shop today pays roughly the same price they would have paid yesterday, regardless of what the paper chart shows. The Shanghai market provided similar confirmation. While COMEX was crashing, Shanghai barely moved. the Shanghai silver price dipped from 104 to 99 during the worst of the selling, a $5 move versus a $26 move on COMEX. The Chinese market looked at the paper manipulation and shrugged. They continued buying physical metal at prices that reflected actual supply and demand rather than paper games. The arbitrage between Shanghai and COMEX is now over $15. This divergence cannot persist indefinitely. Either the COMEX price rises to meet Shanghai or the COMEX becomes irrelevant. Either outcome is bullish for physical holders. The industrial buyers are similarly unmoved by the paper volatility. I spoke with a contact at a solar panel manufacturer this afternoon. They are under contract to purchase 300,000 ounces of silver per month for the next 2 years. Their contract price is not based on the COMEX spot. It is based on a negotiated rate that reflects the actual cost of sourcing physical metal. That negotiated rate did not change because of today's pump and dump. The manufacturer knows that they cannot source silver at $83. They know that the paper price is a fantasy. They are paying real-world prices that are 20 to 30% higher than the paper quote. This disconnect between paper and physical is the Achilles heel of the manipulation. The banks can move the paper price. They proved that today. They can trade 1.8 billion ounces and crash the chart. But they cannot change the physical reality. They cannot create silver where none exists. They cannot force dealers to lower their prices. They cannot compel industrial buyers to accept paper settlement instead of metal. The paper manipulation is increasingly an exercise in futility. It moves a number on a screen while the real market ignores it entirely. Now, let me talk about what this means for you and what you should do in response. First, and most importantly, recognize the pump and dump for what it is. It is not a market signal. It is not price discovery. It is not information about the value of silver. It is manipulation, pure and simple. The price crashed because the banks decided to crash it, not because silver became less valuable. The fundamentals are unchanged. The shortage is unchanged. The industrial demand is unchanged. The monetary debasement is unchanged. Nothing that matters has changed. Only the paper price has changed, and the paper price is a lie. Second, do not sell your physical silver in response to paper volatility. This is exactly what the banks want. They want you to see the crash on your screen, panic, and dump your metal at the local coin shop. They want your metal. They need your metal. They are trying to scare you into giving it to them. Do not comply. Your physical silver is worth what the physical market says it is worth, not what the paper chart says. The physical market says silver is worth $100 to $120 depending on the product. The paper market says 88. Trust the physical market. Third, if you have cash available, consider buying the dip. Yes, I know it feels scary. Yes, I know the chart looks terrible. But the physical premiums are telling you that this is a buying opportunity. The dealers are not lowering their prices because they know the crash is fake. But the paper price is used as the reference point for wholesale transactions. If dealers can source metal at the fake low paper price, they will pass some of that savings along eventually. Buying now while the paper price is suppressed could get you metal at a slightly lower all-in cost than buying next week when the paper price has recovered. Fourth, document everything. Save the volume data. Screenshot the price moves. Record the timestamps. This pump and dump is evidence of market manipulation. The CFTC is supposed to investigate and prosecute this kind of activity. They never have. But the evidence is accumulating. The record is being built. Eventually, there will be accountability. Whether it comes through regulatory action, through civil litigation, or through the simple mechanism of the manipulators going bankrupt, accountability will arrive. Your documentation contributes to that eventual reckoning. Fifth, share this information. The mainstream financial media will not report this pump and dump accurately. They will say the market was volatile. They will talk about profit-taking and technical corrections. They will never mention the 1.8 billion ounce volume. They will never discuss the concentration of trading among 4 banks. They will never use the word manipulation. The truth has to come from independent sources like this channel. Share this video. Spread the word. Educate your friends and family. The more people who understand what is happening, the harder it becomes for the manipulators to continue. Let me now give you the forward outlook because despite the carnage of this pump and dump, the trajectory for silver remains unchanged. The banks have demonstrated that they can still move the paper price, but they have also demonstrated the limits of their power. They traded 1.8 billion ounces and achieved a temporary $6 decline that is already being reversed. The physical market ignored them entirely. The Shanghai premium actually widened. The industrial buyers continued buying. The stackers continued stacking. The fundamental picture is more bullish than ever. The silver supply deficit continues to widen. Mining production is stagnant while industrial demand is exploding. The solar industry alone will consume over 150 million ounces this year. Electric vehicles are adding another 50 million. Electronics, medical devices, and military applications add hundreds of millions more. The deficit is structural and it is accelerating. No amount of paper manipulation can create physical silver to fill this gap. The monetary picture is equally bullish. The Federal Reserve is trapped between inflation and recession. They cannot raise rates without crashing the bond market. They cannot lower rates without reigniting inflation. The fiscal situation is deteriorating rapidly. The national debt is approaching $40 trillion. The interest payments exceed $1 trillion per year. The only way out is currency debasement, and currency debasement is the ultimate driver of precious metals prices. The geopolitical picture favors silver. The BRICS nations are building alternatives to the dollar system. Central banks are accumulating gold at record rates. De-dollarization is accelerating. Each step away from the dollar is a step toward real assets. Silver benefits from this shift just as gold does. Based on these fundamentals, my outlook is unchanged. Silver is going to $100. It is going to $150. It is going to $200 and beyond. The pump and dump operations will continue until the banks are broken, but the operations are having less and less impact. Each manipulation is more costly and less effective than the last. The end game is approaching. In the near term, I expect silver to recover from today's lows within days. The physical buying will absorb the paper selling. The momentum will reverse. The $100 level that was briefly touched during the pump will be retested and eventually exceeded. The banks will try again to suppress the price, but each attempt will be weaker than the last. In the medium term, the delivery crisis at the COMEX will force a reckoning. The registered inventory is insufficient to meet the delivery demands. Force majeure becomes more likely with each passing month. When the COMEX fails to deliver, when contracts are settled in cash against the holder's wishes, the credibility of the paper market will be destroyed. Physical price discovery will take over. In the longer term, the monetary reset will reprice all real assets including silver. The debts are unpayable. The currencies are being debased. The system is unsustainable. When it breaks, those who hold physical metal will be protected. Those who trusted paper promises will be destroyed. I want to speak directly to those who were hurt by today's pump and dump. Those who bought the breakout and got stopped out. Those who were margin called during the crash. Those who watched their portfolios implode while they slept. I understand your pain. I feel your frustration. You were targeted by a criminal enterprise that operates with impunity. You were the victim, not the perpetrator. But you need to understand something important. The banks did not beat you. They delayed you. They took your money on this trade, but they did not change the fundamental trajectory of the silver market. Silver is still going higher. The shortage is still real. The manipulation is still failing. If you were stopped out, you can rebuild your position. If you were margin called, you can start again with less leverage. The opportunity has not passed. It has merely been postponed. The banks want you demoralized. They want you to give up on silver. They want you to conclude that the game is rigged and you cannot win. This is their psychological warfare. Do not let them win. The game is rigged, but we can still win because the physical market is beyond their control. They can manipulate paper. They cannot manipulate atoms. They can crash the chart. They cannot crash the metal. As long as you hold physical silver, you are beyond their reach. Let me close with perspective on what the 1.8 billion ounce pump and dump represents in the larger context. This was the largest single-session manipulation in the history of precious metals. It required unprecedented coordination among the major banks. It consumed enormous capital and margin capacity. It drew regulatory attention that will eventually result in consequences. It demonstrated the desperation of institutions that are fighting for survival. The very extremity of the operation reveals how close the banks are to losing control. A year ago, they did not need to trade 1.8 billion ounces to suppress the price. 100 million ounces would have been sufficient. The escalating size of the manipulations is evidence of diminishing effectiveness. Each operation must be larger than the last to achieve the same result. This is the pattern of a losing war. The physical market is winning. Every day, more silver flows from west to east. Every day, more industrial silver is consumed in products that cannot be recycled. Every day, more investors convert their paper claims to physical metal. The paper supply is unlimited, but the physical supply is finite. Eventually, the finite wins. Eventually, reality asserts itself. Eventually, the manipulation ends. When that day comes, when the paper market collapses and physical price discovery takes over, the repricing will be violent. The 40 years of suppressed prices will be unwound in months. The true value of silver, determined by supply and demand rather than bank manipulation, will be revealed. And those who held through the pump and dumps, who accumulated during the crashes, who refused to be shaken out, will be rewarded beyond their imagination. That day is coming. Today's pump and dump did not prevent it. Today's pump and dump accelerated it. The banks have exhausted another round of ammunition. They have depleted another tranche of capital. They have taken another step toward their inevitable bankruptcy. Hold the line. Hold the metal. The victory that they tried to steal today will be ours tomorrow. This has been Silver Storm Daily. The banks executed the largest pump and dump in history today. 1.8 billion ounces of paper silver were traded to create a $26 round trip. The physical market ignored it entirely. The premiums expanded. The Shanghai price held firm. The manipulation failed even as it succeeded on the chart. The banks are desperate. They are dying. And their death is the birth of a free silver market. Like, subscribe, and share this video with everyone who needs to understand what happened today. The truth is powerful. The truth spreads. The truth eventually wins. We are the truth tellers. We are the stackers. We are the storm. And the storm is coming for those who have manipulated our market for far too long. See you in the next report.